I want to get your take on what Jay Powell had to say. We heard a very cautious Jay Powell, also saying that inflation is moving sideways. Bit of a shift in the language there and the tone. Before Jay Powell and the Fed seemed to be confident it was going in the right direction.
Well, I think he was right to sort of lay out the case that, look, we've brought rates down 100 basis points since we started cutting, and now we're on sort of a pause so that they can actually evaluate what the economy is going to look like in the next year. And given both cyclical factors and I would say structural factors, it makes a lot of sense to be more cautious in the rate cutting from here on in. The cyclical factors are the fact that, as you said, the recent inflation news shows some, stickiness, some stalling out of the progress, less progress than they expected to see at this point. And moreover, the downside risks to the employment part of the mandate have lessened. So that's a reason that you could go more cautiously in the rate cutting. The second reason is a structural factor is, there's some good evidence to think that neutral is higher than it certainly was before the pandemic. And so you have that going up. And if you look at the projections they gave us yesterday, you'll see that median long run Fed funds rate ticked up again. And so both things are happening at the same time. Dual mandate goal progress on inflation, not as much as expected or wanted. And at the same time, we might be closer to neutral than we think. And so both of those reasons, I think, say it's time to go slower on these rate cuts. And I read what he was saying.
Let's talk about that. If you don't mind me
pause.
interrupting you, let's talk about that.
Sure.
You're saying there's evidence that the neutral rate's higher. I mean, I think Jay Powell flat out said it. He said policy is significantly less restrictive now, at least in his mind. As we go forward, the idea of going from 4 cuts down to 2 cuts, is the second cut once again truly data dependent? Because before it kind of seemed like the Fed was determined to make these cuts. Do we need to see significant progress, inflation, get very close to 2% to get that second cut later this year?
Yeah. I mean, firstly, when all these projections are always dependent on how the economy actually performs. And moreover, what does the incoming data tell you about their forecast for where the economy is going? Because as you know, and everybody knows who's watching this, that monetary policy doesn't have an effect immediately. So they always have to be looking forward. But that said, the way I think about this is, in the recalibration phase of this, which is what the chair termed it when he started cutting rates in September, I think you come into a meeting, if you were one of the members, and you'd sit there and say, okay, I come in thinking, right, that we're on this path to getting closer to neutral, and it's got to be evidence that suggests we shouldn't go to the next cut. Now, I think the way I would come into these meetings is I need to see an accumulation of evidence that says we should go to the next cut. So I come in thinking the base case is we're not going to do anything at this meeting, and then evaluate whether the incoming evidence sort of takes me off of that base case. And I think that's the way I would be going in to the next, set of meetings. And I think that's consistent with what the SEP says is only 2 probably this year. I think the thing in the SEP that's good to remember is the forecasts themselves for 2025 and especially 2026 haven't changed that much. It's the policy that's appropriate to get to those forecasts that's changed. And I think that's the way I'd read it. It's going to take a little more restrictive policy than they had been expecting to actually achieve the mandated goals.
Loretta, one last question for you. Again, we've seen bond yields rise since that 50 basis point cut. We've seen a stronger dollar. And again, we do have an administration with policies, proposals. We don't know if they're actually going to be enacted that could be inflationary. How does the Fed view all that going into this new year?
Well, I think they are going to be evaluating those policies, and I certainly think that they should be thinking about what are the potential policies that could come out, what are those expected effects, and then thinking about what's the outlook given those scenarios. And of course, they're not going to react to something that hasn't happened yet, but they should be doing that evaluation, and that will inform their outlook and therefore what the appropriate policy going forward is. So I think that evaluations happen. As the chair said in the press conference, some of the SEP projections did, some members and participants did incorporate some early estimates of what they think fiscal policy will look like into those projections. And that's right. I mean, you have to be thinking about what are those potential policies and therefore what are their effects on the dual mandated goals of price stability